Okay, so guys, thank you very much. It is October 15th, and I am thrilled to welcome you because this is the first video session that we are doing for our brand new forum for realtors for financial analysis. Financial analysis is, of course, very different than legal issues, but probably if I had to estimate, and I'm speaking as a lawyer, more important than law. That's because law follows business. Without business, there is no law. That isn't to say you can dispense with law. It's not to say law isn't important. It's not to say it doesn't have its place. But frankly, you wouldn't employ a lawyer if you didn't have the right business terms to begin with. And even though all of us, or most of us that are on these forums are involved in the residential space, most of us are concerned with convincing clients, rightly so, that their investment makes sense given the size of their investment when they're actually investing in real estate. The financial analysis forum generally that we're starting up is to provide greater financial literacy to our community, both to the lawyers, to realtors, and to others, such that basic financial math is understood by us and that we can be conversant in those facts with our clients. And of course, there's one thing to be conversant in financial math, and there's another thing to be able to explain financial math to your clients. Generally in the residential space, particularly if you have an investor client, they are weighing options as to what to do with their money. They usually aren't made of money. They're usually using mortgage funds as a necessity, not just because interest rates are low. And accordingly, the discussion as to why it is that they should invest in a real estate product over, say, a stock market product or a bond market product or anything else is a real one. And to basically say, oh, well, real estate has gone up 5% per year, or it's always been a stable investment. Yeah, they may even know that to be the case, but that's not a good answer. That's not a specific answer. That's not an answer that really treats them with the professional knowledge that you've been able to acquire over the course of years. Rather, the right thing to do is say, well, let's start looking at some examples. Let's start modeling this out. Let me show you why this is an excellent investment. And so that we all understand why it is that I'm giving this particular talk today, I'm also a realtor, and I think that every single residential deal that I've done, I don't do residential deals anymore all that frequently, but the residential deals that I used to do, I used to win every single deal by sitting down with people at a coffee shop and saying, let me show you how the math works on this transaction. And it's that math that I want to share with you today. I know I'm doing a bit longer of an introduction than I normally do. I will get to the spreadsheet in 1 second. I just want to say one other thing. Financial math is complicated, and it's not something you can get from a single session. The whole purpose of this forum is to gradually introduce concepts and principles surrounding financial math. We started this week with an analysis of future value, an analysis of present value is going to be taking place, net present value, how taxes work. All these things are items that our forum will address piece by piece, slowly and with time. Accordingly, if something that I'm saying today doesn't make sense to you, I would encourage you to, first of all, it's not going to be all that complex today, but if it is complex, because we're going to be bringing together a lot of areas, I encourage you to just stick with the forum. Watch it, learn from it, and as you do, the spreadsheets that we're going to be talking about today will become much more fluid and conversant for you. You'll be able to internalize them and in turn be able to share them with your client. So, introductions aside, let me give the normal caveats. Our forums are private, our videos are public. Anything said on this video is going to be publicly available. And generally, when you speak on these forums, the video camera angle does turn to you. Thank you very much for making this forum that we've just started this week for financial analysis for realtors a huge success. We're up to several hundred members already. I'm looking forward to growing it as we have grown the previous one, but that is not why you're here. Let's turn to math. Let me share my screen and we will get started. Okay, I am going to share my screen on a Microsoft Excel screen right now. Firstly, can someone confirm, please, that they see my Excel sheet? Guys, can anyone confirm?
Yeah, see it.
Okay, great. And you see the whole sheet, right? You see down where by this annual return on investment?
Yeah.
Okay, fine. Should be on investment. Okay. So the first thing I'm going to do is I'm going to describe, and I'm going to really start a bit basic. I'm just going to describe how spreadsheets work generally. And I'm doing this because I know that all of us are expected to have certain knowledge, but the reason that you're here and being educated is partially because some of us don't have basic Excel knowledge. And I will admit, when I went through law school, I didn't have Excel knowledge. It wasn't until I went back to school and did a business degree that I actually developed my basic skills in Excel. So the way Excel works is there is your main page, which is generally what you're trying to show people. It doesn't always work this way, but that's kind of the way a Proforma works, where all of your important data is visually displayed on your front page. And then you see these tabs here at the bottom where it says Basic Canadian Mortgage Calculator and Taxation Schedule. You can make any number of tabs on the bottom. But the purpose of those tabs is to do the background analysis that really powers the front page. And that's the way I have set up this residential Proforma, which is in Excel, and as I should have mentioned, will be available on our website for download once we are done. So once this actually session is finished, I will do it in Excel. I would have done it in Google Sheets, but I've done these types of discussions in Google Sheets before, and they get screwed up when everyone is sharing a sheet. I would prefer to keep master control and just have it downloaded such that you can actually download it yourself. So let's begin. Before I turn to this front page, which is really all the inputs we're going to put in and the outputs we're going to put out, which is going to give us our analysis, I'd like to talk to the supporting worksheets that I've created, which we will be using in order to power this particular input and output sheet. The first is something with which you are going to be familiar, and that is basically the mortgage calculation. In order to figure out exactly how much someone earns on an investment, you need to know how much in principal and how much in interest they pay. And this calculation, which we will go over in short order as we start filling in the sheet, is designed primarily to break down whatever the mortgage amount is into monthly payments, and more importantly, to break that monthly payment into principal and interest components. Why? Because if you're doing a return on investment analysis, then the true cost of an actual acquisition is really just the interest you are paying. Because the principal you're paying back to yourself. And thus, in order to get a true analysis of what the return on investment is, we must take into account how much the actual interest that is being paid is as opposed to principal, not the monthly mortgage payment. We will talk about that in greater detail as we go. I'm just pointing out why this page is here. The other interesting page that we need in order to construct our first page, which we haven't gone over yet, but we will be referencing these pages, so I just want to make us fluid, is of course the marginal tax rates. Speaking to someone and telling them what their return is very different than telling them what the cash in their pocket will be after tax. And a good pro forma analysis does both. It tells them what their pre-tax profit is going to be and their post-tax profit will be. Now keep in mind that when someone says, hey, invest in X, they are usually talking about the returns pre-tax. And indeed, if you're comparing two investments, someone will say it's a 6% return, it's an 8% return, and that is 6% pre-tax, 8% pre-tax. It's just understood in the same way that when someone says, I got a 1.65 mortgage rate, you understand that it's compounded semi-annually because all Canadian mortgages are. So if someone is saying, I have an 8% investment return for you, they're saying pre-tax. But remember that we're dealing with residential world here. And in the residential world, you are not talking necessarily with sophisticated investors. And some people want to know, hey, how much money is going to be in my pocket? And one of the things that agents have never really been able to do is basically say, look, I can tell you how much money you're going to get, but, oh, sorry, someone is saying that, is there a way to expand it? I will, yes, hold on a second, let me just, sorry, someone is saying that you want this bigger, let me just do this. Is that better? Can you see that? Did that expand for everyone? Here.
Much better now.
Okay, all right. So we can go ahead and understand that small-time investors may very well want to know how much cash is it going to put in my pocket. In order to do that analysis, the tax is needed. And we'll talk about how we're going to deal with that in a minute. So that's really the 3 pages that we're going to deal with today. One is the basic mortgage calculator, which I'm not going to be touching too much. The calculations are in here. I can teach you how to do these calculations, and I will be teaching you how to do these calculations on the financial analytics site that we have established over time. But suffice it to say that right now, it will pump out whatever the monthly and monthly interest and principal is. And this one here is taken right from the KPMG tax schedules for Ontario, and it's showing what the actual tax rates are. This is showing what the capital gains rate is, and this here is showing what the normal income rate is. Okay, makes sense? Let's move, so someone is asking, Andrea's adding, can you add an LTC calculator on the back end? Actually, you can add a whole bunch. This is a very basic calculator. I've left out CMHC fees from this calculator. I've left out land transfer tax calculators from this, but actually my personal calculators, when I used to use these things for clients, used to be about 10 pages long, and they used to be very sophisticated. For the purposes of this discussion, Andrea, I am simply keeping this simple, straightforward, and as people have fluency and want to add to it themselves, downloading this will be an availability, and then putting in an LTT calculator is very simple. And that's particularly because I have put in a land transfer tax box here, and all I'm going to do is add that amount as opposed to have it automatically calculate, okay? Arun is asking me if I can change the zoom settings on my spreadsheet. So is it still too small? Let me see if I can do this. Is that better for people? Does that work? Okay. So let me try this as well. There we go. Okay, so let's do this. We are now turning our attention to the first page. And you'll note that the way I've done out my spreadsheet, there's many ways of doing spreadsheets. You can do this any way you want for those of you who are unfamiliar with Excel. But the way I like to do it is I like to keep it very visually appealing and very visually simple. And the way I do that is I basically make a series of inputs which then result in outputs. The inputs, plainly, is the stuff you should touch. The outputs are the stuff you don't need to touch, because that's what the spreadsheet is doing. And I'm going to take you through it. So of all of the things here, everything here will be familiar to you, and you don't need to be intimidated by it, except this very first line, this concept called a discount rate. And so it's going to behoove us to actually just pause for a minute and talk about what a discount rate is, which, by the way, is going to be a whole session of our new forum, the Financial Analytics Forum, or Analysis Forum, in the coming weeks. But the discount rate is a fancy way of saying that if I have X dollars this year, then I will need to have X dollars plus Y in year 2 to equal what it is in year 1. Another way of thinking about it is the declining value of a single dollar in every single year. How much are you discounting whatever your dollar basket is every single year? Because we all know that prices go up. We all know that $10 today will buy us more than $10 in 10 years. How much more? Well, that's predicated upon the discount rate. How much is that dollar value being discounted every single year, such that while still $10, or in today's value, what would $10 buy in 10 years' time? And that's what the discount rate is. And there are other definitions for it. You can look up discount rate on Google. And those of you who are familiar with financial math know this implicitly. But for our purposes, the discount rate is how much less valuable is money every single year, or alternatively, how much more valuable, if you reverse the math on the spreadsheet, is money every single year if there is interest applied. So let's go through it. A normalized discount rate, I'm going to just pick something. I'm going to say that every single year, our discount rate is 3%. So again, what does that mean? That means that if, in fact, I have $10 this year, let's say it's $10, then if I were to take equals $10 and multiply that by the discount rate, oh, actually, I'm sorry about that, equals $10, and I'm going to multiply that by 1 minus the discount rate. Good beginning, guys, sorry. Then it's worth $9.7 next year. That is to say, if there's a discount rate of 3% on money, my $10 can buy what $9.7 can buy today, if that makes some sense. And the discount rate is a bit convoluted. I'm happy to discuss it with you in detail later on. But for now, just assume it's 3% because the rest of our lines in this pro forma will be very, very, very easy for you to understand. The first line that you guys are going to know implicitly, mainly being real estate agents or lawyers, is the real estate appreciation rate. Now, the real estate appreciation rate is how much a house is worth vis-a-vis the year before. And after World War II, does anyone care to guess what the actual average rate of growth was in real estate since World War II? Anyone want to care to take a guess? You guys are used to 10%, 18%, 12%, whatever it may be. It's actually been a fairly steady 5% until the last 10 or 15 years. So 5% is the normalized rate of growth for real estate, 5 to 8%. We're expecting 10%, but let's for now just say 6% per year, okay? That is to say, if you have a house today, you will have to pay 6% more for it next year, all things being equal. And that should be something that is very familiar to all of us. We all track these things. Then we have to say, what is our marginal rate of tax? That's going to be our next input. Now, let's consider what that means. And I'm going to go back, if you don't mind, to our taxation schedule. The way tax works for individuals in Canada is pretty simple. It's kind of like land transfer tax insofar as it's a graduated system. So as you'll see, on the first $44,740 that someone earns, they pay a rate of tax of 20% on that money. So every single dollar that someone makes on $44,740, they have to take 20% and give it to the government. Any amount that they make above, and it doesn't matter if you're a billionaire or if you only have made $20,000 that year, everyone pays on their first $44,740 only 20% tax. The second line, the $44,740 to $48,535, they pay a slightly higher level of tax. They pay 24%. And so on and so forth, all the way up the income chain until $220,000. And if they have earned $220,000 or more in a given year, then every single dollar they take in pays 54% tax. Now that is a sickening amount, by the way. It should sicken you. It sickens me. I would tell you that this is an incredibly political document, the marginal tax rates. And it was the case that I think when, but about 15 years ago, the tax rate was about 43%, and now it's 54%. What's missing from that analysis is, of course, the fact that this raise came at the benefit of all of these particular areas also having been raised. So the government made a policy decision to tax the rich. Everyone who earns dollars over 220,000 started paying a lot more, because before they would have to pay 43% on those monies, and now they're paying 54%. But everyone who earned in these brackets actually started paying a lot less. And that's the way that the governments can sometimes fiddle with the tax system, and it is an incredibly politicized decision. It's also very politicized as to whether or not to allow capital gains at 50% of income, but this is all subject to a different discussion. My point is that on the resale calendar, we were trying to figure out our marginal rate of tax. What do I mean by that? What I mean by that is, where in this particular analysis does your client fall? So let's assume for a second our client is a high income earner. And let's say that he is earning over $220,000 a year. Fine. So the marginal rate of tax is going to be taxed at 53.53%. Every dollar that they take in will be 53.53%. And similarly, the capital gains analysis, I could theoretically just divide this by 2, but I might as well just take it from this taxation schedule, is 26.76%. So if I go ahead and earn $220,000 from my job down at Brookfield Asset Management, and then I make $10,000 extra dollars above that, that $10,000, if earned as income as a real estate agent, needs to pay 54%. But if earned as a capital sale, would have to pay $2,676 as opposed to the $5,353 on that $10,000. Does that make sense in terms of marginal rates so far? Does anybody have any questions about what I've done? And the reason why I'm doing it, just before I ask for questions actually, is because in this pro forma is going to strive to give you your return both before and after tax. And in order to do that, I need to understand the individual's marginal tax bracket in order to provide that analysis. Does that make sense so far? Yes? Okay. The cost of borrowing. So most people do not have the money to afford a down payment. In fact, most people borrow money from other investments or from their parents or from their friends in order to make these investments. And so their line of credit may be very well used. And so let's just assume that the cost of borrowing money for these people is 2.75%. I'll show you how that plays into our analysis very shortly, but let's just put that in for now. And our realtor fees, right? If we are to truly figure out what an investment costs, we need to actually account for all the fees associated with that investment, of which realtor fees are significant. So we're going to assume realtor fees are 5%. By the way, when you're doing an analysis with someone, don't fudge the numbers. Don't say, oh, of course you'll use me and I'll give you 4.5%. So let's just put that in. No, no, no. Assume conservatively, because you always, when modeling for someone, want to assume the worst. So assume that your relationship goes to hell, and assume that they're going to use a different realtor, and that realtor is going to charge them 5% because that's the industry standard, right? Okay. Now, of course, a fundamental feature of understanding how to do a residential pro forma is the mortgage. And anyone who says that they can pay cash for one of these things on an investment should be shot in the head. There is no math which suggests that with mortgage rates at 1.65%, they shouldn't be borrowing heavily for this and leveraging accordingly. We can leave that discussion for a different time. For now, let's just assume that all residential properties are going to be subject to a mortgage for this analysis. They don't need to be. You can put an LTV of 0, which means that there is no mortgage. But for now, let's just assume an LTV of 80%. Again, Andrea, I have not put this in a CMHC calculation. So there would be CMHC calculations that would probably come in here if I had a more sophisticated analysis, but I'm just going to assume no CMHC fee. I'm going to use an 80% variable. And sorry, you asked, yes, I do. Can I have, and what if I leave it in a corp percent? I'm not going to talk about corps and percentages right now. That's subject to a different analysis and how to use corporations. We will be talking about that in subsequent lectures. I just don't want to make this too complex. For people who are not familiar with these type of analyses, these are going to be more than complex enough right now. So our mortgage rate. So what's a mortgage rate? Well, Desjardins is now offering 1.65 on a fixed. Can't believe I'm saying that. Can't believe they're doing it, but what the hell? That's the mortgage rate. The amortization is, let's just bring us back into real, okay? Let's not talk about the exceptional. Let's bring ourselves back into real here. So the mortgage rate is 2.19, which is still ridiculously low by historical standard. Your amortization period, we're going to say we're amortizing over 25 years. Don't assume 30. Don't make it more convenient. Say, look, we're stressing this. I'm showing you what happens in the worst case scenarios. And your term of the mortgage is going to be 5 years. That makes sense. Of course, tax is an expense, and we have to account for tax. Now, the way that taxes are accounted for, and Andrea, if I was building a sophisticated portfolio, I'd have all of the residents and the jurisdictions of Ontario with their relevant mill rate. But what the mill rate is the mill rate is the amount by which we multiply the assessed value to find out what the taxes are per year. So I'm just going to stop sharing for a second, if you don't mind. I'm just going to load up a different forum. And I'm going to show you how we discover the mill rate. So just bear with me, please. Okay, so I'm just going to share with you how it is that I figure out what the mill rate is, okay? Watch this. It's very sophisticated. I type mill rate Toronto. And first thing that pops up is the mill rates. And as you'll see, here's the property tax rates, and you'll see this wonderful thing. There it is. Look at that. There is the total tax rate. Hold on. There it is. 0.599704. Okay? Of a percent. So that is Toronto's mill rate. Let's just plop it in. Oops, can't do that on a merge cell apparently. Can't do that on a merge cell apparently. Well, I'm not sure what's going on, but rather than worry about it, I'm going to stop the share here. I'm going to start sharing again on my Excel so that we're all on the same page and people can see again. And I'm going to tell you that what it said was that it was 0.599704. That's the mill rate. Oops, that didn't work. It's not 59%. 00, so 0.0059. And I'll expand that just to make sure I'm correct. This is, sorry guys, just 1 second, please. There we go. Okay, so we have the mill rate. And the mill rate multiplied by the assessed value that MPAC provides is exactly how much in taxes you have to pay every single year. Okay, then we have a bunch of property assumptions that I know every single one of you is going to understand. Sorry, I'm just going to bring the chat up again in case anyone has questions. Hold on. Someone asked, Jack asked why I used 25 for amortization and not 30. Jack, there's very good reason for that. Many people don't qualify for 30. CMHC is continually tightening its rules. One of the ways it tightens is it wants people to have a 25, which is the standard. 30 years extended. So I'm using the standard because if you're amortizing over 25 years, what you are in effect doing is creating less profit, and therefore it is a more conservative approach. Make sense? Okay. Good. Let's go forward. Guys, do me a favor. Please don't write me privately unless you, if you want to speak about something privately, let's do it after. It's just I need everyone to see what's going on in the text. Otherwise, they don't understand what it is I'm answering as well. So let's do an investment. Let's do an investment of $550,000. Sorry, 1 second, please. Okay, so we're going to do $550,000, and we're going to have land transfer tax on the 550. Now, ordinarily, if you wanted to make this more sophisticated, the moment you typed in 550, you would have actually had a jurisdiction like Toronto. You would have had a pull down. I've had these before. And then it would automatically have calculated what the land transfer tax is, and this would be in yellow. But I'm keeping this simple, and I'm just pulling up a land transfer tax calculator from RateHub, which is a good land transfer tax calculator online. And it's in Toronto, and I'm going to assume that they're not first-time home buyers. Again, none of this is put into my spreadsheet, so you kind of have to do this math and this calculation yourself. But you'll see that the land transfer tax is coming to $14,950. You know what? Let's make them a first-time home buyer. What the hell? Sure, let's make them a first-time home buyer. So we're going to make that a total amount of 6475. So 6475 is the 6475. Now, I'm going to pause for a minute. You'll note that the land transfer tax required me to do a lot of work. It required me to figure out what the jurisdiction was. It required me to figure out what if they were a first-time home buyer and everything else, as opposed to simple pull downs. You can create spreadsheets that do this. You can make this far more sophisticated. And that's the beauty and the power of a spreadsheet. And whatever it is you want to automate, you can automate through math using a spreadsheet. For those of you who are not as familiar with spreadsheets as other people who have been with it for a long time. But I chose not to do that here. I chose to just say, tell me what the land transfer tax is on 550, and it happens to be 6475 because we're dealing with a first-time home buyer. We're not dealing with new construction here, we're dealing with residential. So we're going to assume that the legal costs on this are going to be, say, $2,000. Let's say that that's our closing costs. We can say $2,500 to account for, I don't know, something. Who knows? There we go. How long you're going to own the property in years. Now, this is a critical decision point that we have to think about. Because if you think about it, the real profit in real estate, I don't know if you've ever really considered this, but the real profit in real estate stems from something fairly simple. It stems from the fact that you are gaining appreciation on 100% of the purchase price, but you're only putting money down on 20% of the purchase price. So you get growth of, in this case, we said real estate appreciation growth of 6% on the entire $550,000. But the only amount of money you're going to have to put down on your investment is 20% of $550,000, $125,000, or whatever 20% is. I probably did the math wrong. I hope that makes sense. That's the beauty of real estate. That's the reason we all love it. It's because it's leveraged. And you might be able to say to yourself, well, Mark, I can leverage anything. I could go ahead and buy a business. I can go ahead and, no, you can't. No, you can't. I'm going to just pause here and explain where the value of real estate is. I've had a client who owns a restaurant, a very popular restaurant. You would all know it. In fact, it's a chain of restaurants, and it makes upwards of $3 million in revenues per year. And when they go to the bank and they say, give me money, the banks tell them to go to hell. And they've done this for 20 years. And if they do get money, they get it at 12 to 15%. So why is it that Mark, that has a ticker that can go at any minute, why is it that Mark can go into a bank and the banks will fight to give me interest rates of less than 2%? It's because this is Canadian backed. It's because after World War II, the Canadian government said, we want to back Canadian housing. And they do it through CMHC insurance. And they also do it through, and it's also a very liquid market. And as a result, really what we're talking about here is being able to leverage at government rates 1.65% on money. And that's the reason real estate makes money. If you've never really thought about it, it's worthwhile thinking about this concept. Okay, so how long are we going to own this property? That is to say, how long are we going to continue to make 6% on other people's money? I'm going to say 5 years. Okay, I'm going to assume this isn't a condo. Oh, what the hell? Let's make it a condo. Let's make it $350 a month. Let's say that we're going to have miscellaneous payments of, I don't know, we're going to say that the condo doesn't include hydro and heat. And we're going to say that this is a rental property. So I'm going to say that we're going to make $1,800 a month in rent. Okay? Seems conservative. Seems like an investment that you guys can find in the market today. Okay, no problem. So now I am going to go through how it is that this comes to this answer. And I'm going to save this spreadsheet once I'm done. I'm going to do the math such that these outputs happen automatically for you as we go forward, okay? I'm doing this, I've erased these lines specifically because I want to show you how it is I build it. And then you will understand how it is that this comes to bear. So first, and I apologize, just give me 1 second, please. So first, what's our purchase cost? So our purchase cost equals, and by the way, for those of you who don't know, when you put equals, you're telling the spreadsheet you're about to do an equation. Equals your purchase price plus your land transfer tax plus your closing costs, right? That's how much it cost you to get into the product. It's not $550. That's not accurate. You had to come up with additional cash. We need to account for that cash. That's the purchase cost. And how much of that is being provided by the bank? Well, you know that you're getting $550 and you're multiplying that by the loan to value of 80%. So the bank is providing $440,000 of that. And therefore, your capital investment is this minus this. I'm going to pause for a minute. Does that make sense to everyone here? Firstly, what I've done in the analysis so far. Jack gets it? Awesome. Can I just get a couple of other people telling me that they understand this? Because I want to go through this whole thing and make sure you guys are familiar with this. Andrew gets it? Great. Okay. I'm going to assume that that there is now understood. Now, in order to figure out what our return on our investment is, we then are going to turn our attention to what the monthly mortgage amounts are. You will recall that I have this spiffy little mortgage calculator that I have worked out in the back, and none of you can see it. So I'm going to make it 200. There we go. So I have this spiffy little mortgage calculator that we had dealt with. And you'll see that it has now automatically filled itself in from my previous inputs. And it has discovered that, hey, the bank is extending $440,000 and it's put an interest rate of 2.9%. And then it's figured out what the monthly mortgage payments are and broken them out into interest and principal, right? Everyone see that? Everyone understand that? That's basic mortgage math. So what's my monthly mortgage? My monthly mortgage is this. That's what it is, right? That's what I have to pay. That's the reason it's minus. What are my condo fees? Well, we know what that is. That just comes directly from there. And of course, it should be minus. What are my miscellaneous? Oh, look at that. Sorry, guys. Part of building out spreadsheets, I don't know if any of you have done them, is being a stickler for details. I cannot stand when my things don't look good. It drives me nuts. So equals minus this. What are my tax payments? Okay, well, we know what our tax payments are on a monthly basis. It equals, let's assume that our assessed value is the purchase price. It's going to be roughly around there. So we're going to talk about this, and we're going to multiply that by the tax rate, and we're going to do that whole thing, because this is a monthly analysis, divided by 12. Now, you don't need to remember this, guys. Oh, hold on a second. That doesn't look right, and anyone who says that does look right should be shot in the head. So I put in an extra 0. No, that's not. I know what the problem is. Sorry, it's point and it's percent. There it is. So our tax payment is $274. Now, remember, guys, you are going to actually have access to the sheet with me having filled this out. You don't need to remember how to do this. The spreadsheet will already have all of this math so you can see what underlies it. I'm filling it in for you so you can see. Andrea asks, are returns typically discussed factoring in a discount rate? Yes, they are. And we'll talk about that. I'm not going to talk about that too much. I'm trying to shy away from discount rates, Andrea, because I'm going to talk about that in subsequent discussions and sessions and everything else. It's a bit more complex. And I understand that a discount rate is the one thing here that's going to give people pause. So with your permission, I'm just going to stick away from it. So my tax payment, and none of you caught this, should be negative, right? Because that's how much I'm paying. And the rents are of course positive. So that comes directly from here. Okay. Now, the next line that we have borrowed how much money? We've borrowed $118,975. And some of you will say, oh, well, Mark, I haven't borrowed it. I have $118,975. I have wealthy parents, or I did really well in life. That doesn't matter to me. I don't care if you borrowed it or if you're not investing it. One way or the other, that money is costing you to invest in this product. And so a good way, should the tax payments be minus? Yes, no, it is minus. Oh, that was written before P. Yeah, okay. Yes, and so one way or the other, the borrowing down payment is going to be a cost to you. Because had you not invested in this, you could have taken your $118,000 in cash and put that into an investment. Or if you're like most people, you've borrowed it from a line of credit, which is actually costing you money. And thus, we should be taking our capital investment like that, right? That's the amount of money we've had to put down, and applying that as against a cost of borrowing. And of course, because this is monthly, we should multiply that by 12. And, sorry, not multiply that by 12. Where are you guys? Divided by 12. And this is a negative, right? Again, don't worry about doing the math. You're going to have this spreadsheet. So I'm doing the math for all of us right now. So it's going to cost us $272.65 in order to actually have that $118,975 available. And thus, it is that the monthly cost of this is minus $1,101.29. Now, that is usually where people's analysis stop. And if someone saw that, they would say, to hell with this, I don't want to do it. But that's not where the true analysis ends. In fact, we should be going on in this sheet to figure out exactly what it is that this actually truly costs. Because remember, the monthly mortgage amount here, so let's do the monthly mortgage. Let's take it equals the monthly mortgage. Just going to go back here, take the monthly mortgage. There it is. Oh, look at that. Well, let's just fix that if you don't mind. Again, I'm a stickler for this type of detail and it matters to me. I don't know why, but it does. So the monthly mortgage is $1,903 and the condo fees are, as discussed, $350, and the miscellaneous is, as discussed, $100, and the tax payments. So I'm going to just do this equally. I'm going to just take this because this is the same thing, and take this because that's the same thing. I'm going to take this because that's the same thing. I'm going to take this because that's the same thing. I'm going to take this because that's the same thing, and then I'm going to take something else. Because of this $1,903, you will recall that there is interest and there is principal. And that principal really shouldn't be considered a cost. I mean, yes, it goes out of your wallet at the end of every month, but it goes out of your wallet into your wallet in the form of paying down your mortgage. And as a result, in order to do a true calculation, we then need to take this, and there we go. So we need to take, sorry, equals minus. Oops, that's not right. Ignore me, kiddies. There's people who are better than Excel. Sorry, 1 second. Okay, so equals minus. So now I have the true mortgage cost associated here, right? What I have is the monthly mortgage, but I'm adding back the principal, because if I pay $1,903, a portion of that, that being $1,100, goes right back to me. So that's not really a payment. That's just transferring money from one account to another. That should be discounted. And now I can do the true valuation, monthly cost. And look at that. Actually, this property doesn't cost me anything per month. In fact, it's break even. Now, think about how powerful this is for your clients for 1 second. What you've now done is you've said to them, yeah, you're going to lose $1,100 a month. True. But you're not losing it. You're just moving it from one account to another. It's not lost at all. In fact, you can hold on to this investment for the next 5 years, and it will cost you not a dime. In actuality, from a cash flow perspective, it's going to cost you $1,000 a month. But in an aggregative sense, because we're looking at this from an investment perspective, you are going to make $3.12 on this. And you want to see something really good? Because now's when you kind of use your lure. What if we were were to change the interest rate to actually what it is, let's turn it to 1.65% from Desjardins. Look at that. You're now making $200 a month from this investment. Yes, you're still losing $987. Let me ask you, sir. Let me ask you, ma'am. Do you contribute to an RSP? It's the same thing. You're paying yourself. Yes, it's leaving your bank account, but it's for you. And this is the same thing here. So I'm going to go back to 2.19 if you don't mind. Oh, what happened? Oh, that's weird. Let me just try one more second. I'm assuming no one has a 219% interest rate. There we go. Okay. And do you want to see something really good, Mr. and Mrs. Investor? Sorry, Andrew's asking, sorry, Mark, about cost of borrowing versus mortgage rate. So the cost of borrowing is different than your mortgage rate. Generally, people borrow from lines of credit. Lines of credit are usually 1% or 1.5% higher, or they're borrowing private. They might be getting it from 5%, 6%, whatever the cost is of them borrowing at their rate. That's what the cost of borrowing is. The mortgage rate is the amount that the bank is ready to extend. You know what the mortgage rate is. I don't need to explain that to a bunch of real estate agents what a mortgage rate is. But the cost of borrowing is what every individual can access money at, and that's different on an individual basis. If you're accessing a home equity line of credit, it's usually 1% above prime or 0.5% above prime. If you're accessing company funds, it might be 5%, who knows? But where they're getting this money from is important because that is a true cost, right? Make sense? So yes, you would use 2.95 there for the cost of borrowing, correct. That's right, Jack. Okay, now, you can say, all right, so we understand that on a monthly basis, you're fine. But you're not doing this for, how did I come up with the principal payment? Is it averaged? No, the principal payment is spread out every single, no. Andrea, with permission, I will go into, I will do whole section. There's a lot that I want to cover in this financial analysts forum. The whole reason why I've set up a whole separate forum for this is I want to discuss mortgages and how they're calculated. I want to discuss taxes and how they work. I want to discuss all of the features that you need to know to be conversant in financial analysis. And so with your permission, I'm just trying to, this is the beginning of our forums and our learnings. And this is really complex for a lot of people. So I'm just trying to keep it very simple for now. And I apologize, but I will do a whole thing on how to do the financial math and how Excel works for principal repayments and how the PMT functions and everything else, okay? So let's turn our attention now. The people who have invested and who you're convincing to pay you the big bucks do not give a crap as to whether or not they are making $3.12 or whether they're spending $1,100. That's not to say that they don't care. Of course they care, but that's not the reason that they're motivated for this. They want to know if this makes sense as an investment opportunity. And to understand that, we have to understand what is effectively the rate of return on the investment. And so the next stage of our analysis here is going to be dealing with the returns on the investments. So let's do that now. And I'm sorry, I have a private message. Again, guys, I'm going to ask, please leave public messages. All right, so let's do the sale price. So what is our sale price? Well, we don't need to guess what our sale price is. We are simply going to take, we're going to simply take our purchase price and we're going to multiply that by 1.1 plus this. I will explain what I've done in a second in Excel. This is going to look a bit confusing, but it won't be because you'll be able to use it yourself. To the power of, how many years are we holding on to this property? How will we hold the property in years? Okay, let me explain what I've just done. Okay, you don't need to understand the Excel that I've just done. I'm going to explain what I did. What I did was I took the purchase price and I multiplied it by 6% per year compounding, meaning that in year one, 550,000, do you calculate an increase in value? Yes, that's what I've done. So what I've done is through this, if anyone wants to see the math, what I've done is I basically said, I am taking my interest rate on real estate, that is 6%, and I am compounding it. If any of you want to see how to do that, I've talked about it in a previous session on this forum. I pushed X to the Y for however many years we're holding on to this investment. And accordingly, I was able to say 6% year over year over year over year, 5 times, that was 4 times, but 5 times, will net 736,024.07 in 5 years. So by simply having the appreciation rate here, the 6%, I've been able to project a reasonable sales price for that $550,000 investment if you hold on to it for 5 years. Does that make sense? Don't worry about the math. Don't worry about this complicated thing where there's this little chapeau and everything else. Who cares? You're going to have this spreadsheet. So you don't need to worry about how it happens. You just need to understand that that's what this calculation is doing. Does that make sense? Okay, good. So we can now figure out our profit, can't we? We can say, all right, in year 5, I'm going to take 736,000. I'm going to subtract the true purchase cost, and I now have a profit, a nice little profit of 177,149. But that's not accurate. That's what would happen if I simply take my sale price and I subtract my purchase cost. Sorry, yes, my purchase cost. But we all know that there's also the profit plus this, right? Because that's how much I'm making every month. And it may be a minus, it may be a plus, who the hell knows? But I am making that every single month. So I'm going to put that times however many years I'm going to own the property times 12. Let me just make sure that that's right. Plus, so this. So to be clear, in order to figure out the profit, I actually then go ahead and I take my sale price, I then subtract the actual purchase cost. That shows me what my actual gross profit is. And then I have to add back all of the monthly benefits that I have accrued. Now at $3.12, that doesn't make much of a difference. But if I were to once again convert this back to 1.65, you'll see my profit has jumped from 170 to 189. Why? Because every single month I'm now making $200 extra that I need to account for. And that $200 every single year is now $2,400. And there's 5 years to account for. And Andrea, if I wanted to make this a more complex calculator, I would also be compounding that interest across the board. But again, let's just keep it simple. So we understand now that my sales price is this. My profit is $189,000. But that's my profit before my, oh, you know what? I'm sorry. I set this up slightly differently. I apologize. I made it even simpler to understand. I'm sorry. What I did was I took the sale price and I subtracted the purchase cost. That gave me my profit. I apologize. We'll go into this in just give me 1 second, because here the accrued benefit and detriment of ownership is a separate line item. I was including them all in the same line item here, but actually I made it a separate line item, so I apologize. So the profit is very simple. The profit is simply what your sale price is minus your purchase cost, okay? Then your realtor fee. Your realtor fee is going to be this times 5, oops, that's not right, that's the wrong one, times, where's my realtor fee? Realtor fee, 5%, and times 1.13, right? Because we have to pay tax on that. Remember, these are investors. So you have to pay interest, you have to pay HST. So the realtor fee is going to be $41,000, and of course it should be negative, right? So negative $41,000. The accrued benefit and detriment of ownership is the part that I had dealt with before. So every single month, they're making $200 under this scenario, which multiplied by 12 gives you the annual, and multiplied by the amount of terms time you're holding onto the property, 5 years, gives you the actual amount of money that has been paid towards the that you have actually benefited from holding onto this property, right? Now that could be negative. That could very well be negative. So if I put this interest rate of 3%, you'll see that suddenly every month this is costing me $300, even accounting for the fact that I'm paying back my principal. And thus, I have to subtract that from this analysis. But I rather like saying we're going to be at 2.1 and we're going to have an accrued detriment of 2149 and we're good. And thus, our gross profit is now discernible. Our gross profit equals the sum of these things. We take our profit, we subtract our realtor fee, and then we add in or subtract the accrued benefit or detriment of ownership. And we now see that we have a gross profit on this of approximately $140,000. Note, we have now done something extraordinary in today's market. We have, I'm just turning my attention to one thing on a separate computer screen. Please bear with me for 1 second. We have, in an instant, taken an investment of $118,975. And we've created a profit of $137,000 in 5 years. That is a pretty good return on investment. And if we had done that in 1 year, you know what that would mean? That would mean that we had taken our gross profit and then divided that gross profit by our capital investment. And we suddenly have a pre-tax return on investment of 115%. Now, that's kind of fictitious because that's assuming that you've had this growth in 1 year. Remember, we've done this over the course of many years. So we would take this and we would divide that by the number of years you were holding the property. So that's going to be 5 years. And that gives you an annual return of 23% on this before tax. And this is the critical number. This is the critical number that they will be comparing as against their stupid ass stockbroker, excuse me, I'm being recorded, their stupid stockbroker who wears suspenders, who tells them that they can get a 12% return. Because what you're going to say is 12%, let me show you what my spreadsheet shows. And you're going to show them a 23% return, which is, by the way, for those of you who aren't strong in math, higher than 12%. Now, you're going to turn to your unsophisticated investors and say, but look, there's tax to be paid. And there could be income tax or there could be capital gains. We're going to have a lot of discussions in our financial analysis forum on taxation and the difference between capital gains and income tax. And I have some speakers lined up and it's going to be a lot of fun. And we're all going to, sorry guys, I know we're going past 11, but I'm almost done. So we are going to have a discussion about that. But you could say, look, in the worst case scenario, let's say the CRA comes in and says that it's going to be income tax that you have to pay. Okay, fine. So let's go ahead and figure that out. My after-tax return, 1 second. So what is my after-tax return on income tax? So I'm going to simply take my gross profit. Oops, sorry, I did that wrong. I'm simply going to take my gross profit like that, and I'm going to multiply it by my marginal rate of tax. Sorry, I'm going to multiply by 1 minus my marginal rate of tax. Where's my marginal rate of tax? There it is. And for those of you who are concerned, I'm going to say marginal rate of income tax, just so that we're clear. And then I'm going to say, just so that it's clear here, marginal rate of capital gains tax. Capital gains tax. Okay, just so we're clear and everyone's good. So I now have an after-tax return of 63%, which means that I'm able to take this, divide this by this, and get a return of 53%. And I could take that and I can divide that by the number of years of the investment, which I keep on forgetting where it is. There it is, 5. And that's giving me after-tax returns of 10.75% if I have to pay income tax. And if, in fact, I have to pay capital gains tax, I take my gross profit and I apply it by 1 minus the capital gains rate. And then I'm going to take this, I'm going to divide it by this. I get 84%. I'm going to take this and I'm going to divide that by the number of years. And we are done. So what we now have is we have this beautiful formula where we can say to our investors, hey, if you go ahead and borrow from your line of credit, let's talk about the whole story. Borrow from your line of credit, which is currently at 3%, or what is your cost borrow? 2.75%. And you borrow $118,000 today. I'll put you into a condo, which will cost you $550,000. And you will make $35 a month. Not in actuality, it will look like you're losing $1,000, but you're making $35 a month. And if you sell it in 5 years and assuming a 6% return, you will actually be able to make a pre-tax profit of 23% per year. If you want to figure it out after tax, even assuming for the worst tax, income tax, not capital gains, you're going to make 11% per year. And if you want to just assume a capital gain, which is what it will be, then you're going to make 17% on your money per year. Invest in me, not Mr. Stockbroker. And that is the residential calculator for resale properties. We will be doing many more of these. I'll do new builds, I'll do assignments. I will build out these calculators and I will have them available for download. I know we're a bit past 11 o'clock today. Does anybody have any questions? Now, keep in mind, these questions should be general and easy. If you have any complex questions, I'm happy to answer them after. This is for people who want to get started and understand this. Okay. So guys, thank you for joining the forum. We're going to be doing a lot of this type of stuff. Please invite your friends. We're only a couple of hundred people right now. And I would love to continue this talk. Financial analysis is much more important than anything else you could know in terms of being a good realtor, in terms of understanding your numbers. So thank you. This spreadsheet will be available. Once I have the video up, I will put up this Excel spreadsheet for download from the site. And actually, as we start creating spreadsheets, which is part of what this site will be for, all of these things will be available for download just so that everyone can use them. So check back in an hour or two. Okay, guys? Thank you, everyone. Again, our realtor site, I should mention it. Our new site, what's the name of our site? Can someone help me out? What's the name of our new site? I'm calling it something else the whole time. I'm sorry, I'm just gonna go into Facebook and tell you what the site is. I forget what it is. Hold on. Bear with me, please. So our new site is called, and I'd encourage you all to join it, please, because I'm not gonna cross-post these things all the time. It's called the Ontario Real Estate Financial Analysis Group for Realtors. Ontario Real Estate Financial Analysis Group for Realtors. I encourage you all to join. Thank you guys, my very best. Have a great day.